Let me read you this title from Fortune magazine. It says, Morgan Stanley analysts think commercial real estate is heading for something worse than the great financial crisis. Here's what Goldman Sachs and UBS have to say. The reason why Morgan Stanley analysts are concerned about the commercial real estate market is because of two reasons. Number one is over the next 24 months, we're going to see a big chunk, about half of all commercial real estate debt readjust because, again, commercial real estate debt is not a 30-year fixed rate mortgage. It readjusts every some years. So in the next 24 months, we're going to see about half of the commercial real estate debt readjust at the higher interest rates, assuming the Fed keeps interest rates high. And the second part to that is that we have a lot of office vacancies that are sitting there losing money for landlords. Let me show you a second article. This article right here is from Business Insider, and what it says is that number one, Blackstone reported big losses in the last quarter. Blackstone is one of the largest owners of commercial real estate in the world, and they saw a huge decline in the earnings for commercial real estate properties. According to their numbers, profits from the sale of the assets fell to $4.4 billion over the last quarter, which is down 54% during the first quarter of last year. So while Blackstone didn't actually lose money, their profits are down about 50% from last year, which really isn't that surprising, but it shows you how much slower the real estate market is now compared to a year ago. But it gets even more interesting. Take a look at this. We have another company, Brookfield Corporation, which defaulted recently on $161 million worth of commercial real estate debt tied to office properties. And recently in February, Brookfield also defaulted on $784 million of commercial real estate that was backed by two big office towers in Los Angeles. So what are we seeing happen? We're starting to see some investors, landlords who owned commercial buildings, primarily office buildings, that are now sitting vacant, that are losing money, where then the debt on these properties are being readjusted. And now the landlords are saying, well, if we cannot make the debt payments and then the debt payments readjust at a higher price, we can't continue to make these payments. So either they default, they try to sell it. If you can't sell it, you have to offer a discounted price, or you get stuck in a very deep position where now you have to keep making payments and bleeding cash, literally losing money, because if you own an office building and it's sitting vacant and the tenants are not renewing their leases, you still have expenses to pay. You got to pay your property taxes, you got to pay insurance, you got to pay the maintenance fees, you got to pay the management fees, and then on top of that, you also have to pay your debt payments. Well, if you have no income coming in, you got to pay these payments through your pocket, through your savings, through your other investments. And sure, maybe you can go by for a little while, but then if you have commercial debt that readjusts, like we're seeing happen over the next 24 months, where a big chunk of the commercial real estate debt is going to readjust, and then your monthly payments double because your mortgage payment went from 4% to 8%. Well, now all of a sudden, you're going to see much bigger expenses, which means you're going to need more rental income. But the problem is, if you're sitting there vacant with an office building, with tenants that are not willing to re-sign at a higher price, with tenants that you cannot even find, you're going to struggle making those payments. And this is the tough situation that we're seeing for a lot of commercial real estate across the country, is that this hybrid work from home environment is changing the landscape for commercial real estate. And so now, if interest rates stay high, that's going to put a lot of pressure on these office landlords to either A, get tenants back into their offices, B, convert these office buildings to something else like residential, C, try to get more money out of their properties, or D, sell while they still can. This is why you're seeing a lot of experts, some people saying that they are predicting a big shift in the office real estate market, the commercial real estate market, because of all these office landlords who are going to be sitting underwater on their properties with loans coming due, which could cause a lot of loan defaults in the commercial real estate space. This is where, if we go back to the Fortune magazine article, we also have comments from Goldman Sachs and UBS, again, two of the largest investment banks in the world, that also commented on the commercial real estate market. Let me first start by talking about Goldman Sachs, because Goldman Sachs is more along the same lines as Morgan Stanley, where they see pain ahead in the commercial real estate market. Here's what Goldman Sachs had to say. Goldman Sachs says most of the fundamental troubles for commercial real estate preceded last year's backup in policy rates. In other words, the higher interest rates are the reasons why we're going to see a shakeup or more pain in the commercial real estate market, not just because of office vacancies. They said commercial real estate borrowers are already exposed to higher interest interest rates, which translates to higher funding costs and increased exposure to floating or variable rate liabilities. In other words, commercial real estate by itself is already exposed to higher interest rates, and they have the variable interest rate loans like I talked about earlier. And because they have these higher interest rates plus the variable interest rate loans, we're going to see a big shakeup in the commercial real estate market, particularly the office real estate market, as these interest rates readjust. Goldman Sachs goes on to say that they estimate that $1.07 trillion worth of mortgage loans will mature before the year-end 2024, and borrowers' ability and willingness to do so amid higher rates will be limited. In other words, we're going to see over $1 trillion worth of commercial loans readjust, not within the next 24 months, but by the end of 2024. And when those trillion and some loans have to readjust, you're going to see limited interest in the landlords wanting to readjust, meaning more landlords will want to sell. And if more landlords are selling, well, that's more supply of these commercial buildings on the market, which could push the prices of this commercial real estate down. And the third factor that Goldman Sachs highlighted is tightening lending standards. Goldman Sachs points to tighter lending standards ahead and the effect of that on both banks and those within the commercial real estate market. In other words, Goldman Sachs says, for one, that you have these variable interest rate loans and the higher interest rates in commercial real estate. Second, you're going to have less demand for people wanting to actually refinance their real estate. And third, the icing on the cake, the tightening of lending standards is going to make it more difficult for commercial real estate landlords to be able to readjust. And all three of these factors together will cause pain in the commercial real estate market in the coming years. Now let's compare that to UBS. Let's start with the punchline for UBS, because UBS says that, quote, a repeat of the 2008 liquidity crisis is unlikely even if credit tightens further. Now that doesn't mean that UBS believes that we're not going to see a shakeup in the commercial real estate market or that the fundamentals of commercial real estate is different. UBS still believes that we have a large amount of commercial real estate debt that is going to readjust in the near future. What they said is that UBS expects around $1.2 trillion of the outstanding $5.4 trillion commercial real estate debt, aside from multifamily, will mature and be up for refinancing. And that will likely happen amid higher interest rates, which they say will only add to existing challenges around servicing debt, especially in areas like office real estate. So UBS, the bank, essentially agrees with Goldman Sachs and Morgan Stanley as to the risks that are out there and the concerns with the commercial real estate market, but the difference is what UBS thinks will actually play out because of these risks. Take a look. UBS says that those defaults don't necessarily mean that there is risk to the entire commercial real estate sector as a whole. And instead, what they say is that office properties account for only 15% of the commercial real estate market. So UBS, just like every other bank, says, yeah, there are red flags in the commercial real estate market. We have a lot of debt that's going to readjust. This is going to readjust at higher interest rates. But the main sector that is exposed and that will probably hurt is office real estate. Every bank is agreeing on that. But then what UBS says is that because office real estate makes up only 15% of the entire real estate market, that it's not going to create like a domino effect in the real estate market. So what every bank agrees upon is that we're going to see a shakeup, particularly in the office real estate market. But the disagreement is how this office real estate shakeup is going to affect the other sectors of the real estate industry. But it all comes back down to what I was talking about earlier with interest rates and what the Federal Reserve Bank is going to do. This is why you want to keep your eye on what the Federal Reserve Bank does, because if the Federal Reserve Bank continues to raise interest rates and they continue to keep interest rates high, that is going to play a major impact on commercial real estate. It's going to play a major impact on corporate debt. It's going to play a major impact on credit card debt. And it's going to play a major impact in our national debt, because all of these debts are variable interest rates. And if our debts continue to rise or stay high, that's going to make the cost of servicing these debts higher. And while we don't see the exact cost of this yet, as more and more of these debts readjust over the next 12 to 24 months, we're going to slowly start to see the impacts of this, which is why you want to make sure you're staying financially educated. You want to make sure you're prepared and stay on top of what's happening. And of course, we try to keep you updated with Market Briefs, my free financial newsletter, which is why if you haven't joined Market Briefs yet, I highly recommend you do so. And I got the link for you down in the description below. Our last inflation report came in cooler than expected, which naturally has some people excited, claiming the win on the inflation fight, which then poses the next natural question. If inflation is falling, does that still mean that we're going to see a recession?
And what's interesting is just a few days after the inflation report came out,